Hello everybody, welcome to another update on the stock screener. Today I'm going to tell you a secret on how to make money on the stock market. It's really easy. You just buy stocks that are undervalued and just sell them when they are overvalued. So I have three metrics that I use to determine whether a stock is undervalued. So you need to have a PE ratio below 10, a price to book value below 1, and a price to earnings growth ratio below 1. Okay, so let's go over each metric. So let's say you have a company at a price of $10 million and it has earnings per year of 1 million. Okay, so that's a PE ratio of 10 divided by 1, so that's 10. Okay, and that means that each year this company will earn $1 million. So we start with 10, then next year it becomes 11, and then 12, and then 13. So the profit per year is 10%. So that's a good return. And if the PE ratio goes below 10, that means that the profit per year will be higher than 10. And that's what we want. So that's the first metric. Buy a stock below a PE ratio of 10. Then we have the price to book value. So let's say your company is worth $10 million, but the stock price tells us that the market cap is below that $10 million. So that means if you sell this company and you have the assets minus the liabilities, then you would have a profit because you could sell it at $10 million while the market price is below $10 million. So you buy it below 10 and you sell it at 10. So you get a profit. So that's our second metric. Buy a company that is trading below the equity value. The third metric is price to earnings growth. So that's just the PE divided by the growth. For example, you have a PE of 20 and this company grows at 20% per year. So 20 divided by 20 is 1. So that's a good company. It might have a high PE ratio, but it also grows 20% per year. So of course, you need to know if this growth is sustainable. So that's important to watch. So now let's use these three metrics and apply it to a stock. And today we're going to revisit a favorite of mine, and that's ArcelorMittal. So ArcelorMittal, you can see the stock has bottomed out and it looks like it is ready to start rising in the coming years. So it has gone down since 2010 and now we are 10 years later. I think we are now bottoming out and starting to rise again. And why do I think that? Look at this chart. So in 2010, we see surplus on aluminum. And this surplus has stayed here for 10 years until today. And from now on, we are going to see deficits coming in the aluminum space. You see that? It starts somewhere in 2023, and the deficits are going to become larger and larger. So why did I show aluminum? Because steel is correlated to aluminum. So if aluminum goes up, they will probably start substituting that and use more steel. So these prices are going to rise based on these fundamentals. You're going to see deficits, and this will be positive for aluminum and steel. So let's look at the valuations of ArcelorMittal. So today we have a market cap of around 30 billion. So that's the market price of this company. The equity is already at 45 billion. So what does this tell us? The price to book value is 29.8 divided by the equity, 45. So this is a price to book value of 0.65. So you are buying this company below book value. That's one of my metrics that are positive. Okay, so if this company were to sell all of its assets and pay off the liabilities with that, then you would earn immediately 30% because it's 30% below book value. The second metric is the PE ratio. So the price 30 divided by the earnings, which are 13, gives us a PE ratio of 2. This is significantly below 10. So if you have a PE of 2, that means that this company is earning 50% profits per year, right? 50% profits per year. At a PE of 10, you have 10% profits per year. And here, you will earn 50% profits per year. Because you start, for example, at 30 billion. And then next year, we add almost 15 billion to that. So that means that this will rise by 50%. Okay, that's a very good return, 50%. So this is really undervalued. And there's also growth. Why is there growth? Because the price is going to rise in the future. The price is going to rise in the coming years because there will be deficits. So this has actually gone down over 10 years, and now the price is going to rise. Actually, you can see this here as well. So let's start with 2010. So the surplus went up in 2010 to 2015, and you see the price go down. Then it went down again, so the surplus went down until 2019, and the price went up. And then we see a rise in surplus again, and the price went down. And now we are going to massively go into deficits. So I would expect the prices to shoot up until 2026. So prices up means revenue up, and that means PEG ratio massively down because there is a lot of growth coming due to increased prices. So we have here a stock where the 3 metrics are positive. Price to book below 1, price earnings below 10, and a lot of growth. So that's what I wanted to show you here. I'm going to start a new position in ArcelorMittal. Going to keep accumulating because we are in a bull market here. And I'll see you in the next video.